Give everybody another minute and then we'll get started. See, people are coming across from the other invites, the other events. Okay, I think we'll go ahead and get started. So welcome everyone. My name is Nancy Amert. I'm the director of the Trade Innovation Lab at CGI. We are recording this webinar for those who may have had a schedule conflict or who were unable to join us today. So welcome to the Sibos Meet the Experts webinar. This is hosted by CGI, and thank you so much for taking the time out of your busy schedules to join us for this discussion. I'm sorry, was there a question? No? So we're going to actually have the time today. We'll have about 15 minutes, hopefully, for a rousing discussion related to whether or not global bankers hold the keys to climate change. And if so, what kind of impact we may have already seen within the financial marketplace so far, and also what's coming up. We're also going to discuss whether there's also enhanced financial incentives offered by different governments and nations, and also increased regulation, or both. And are the bankers actually really embracing their new role as climate stewards? And what evidence do we have that this is happening? So this is an interactive webinar, so please feel free to ask questions along the way or place them into the Teams chat window, and we'll queue those up, and Matthew will help me with that as well. So with me today as well, I'd like to go ahead and introduce Matthew Irist. He actually comes to us and he's just recently joined CGI, so he is an expert within ESG and also the Wealth and Capitals group. So Matthew, if you want to say a quick hello, that would be great.
Yeah, hi, I'm happy to be here, and I'm happy to share and discuss this very important topic.
Thank you, Matthew. So quick agenda, we'll actually be talking about the existential threat of climate change. Then we're going to move on and talk about the global financial marketplace, and the transformation that we're witnessing, and what the push is and where it's coming from towards sustainable finance. We'll also talk again about the bankers' role as climate stewards and what impact the global bankers can actually have on climate change. So again, just to again welcome and introductions, I'm Nancy Amert, and that's Matthew Irist, and we're going to take you through just a handful of slides and then open it up for hopefully, again, a very interactive discussion on a topic that I don't think is actually getting enough attention, or has not really been put into a framework such as what we're offering today. So as everyone, I'm sure on this call is aware, it's been called the climate crisis. Just recently in reading and getting ready for this webinar, it was very interesting because the language is now shifted and it's being called now a climate emergency. The UNICEF, interestingly, just last week issued a report, and they said the climate emergency is at our doorstep. And they've actually reported how already 1 billion children are already at extremely high risk from the effects of our rapidly changing climate. And this could be whether it's the heat waves, the floods, the cyclones, disease, and drought. It's leaving a rather stark impression and a stark reality for not just our children today, but also what impact this is going to have on our grandchildren. We've also wanted to include a very recent quote from Larry Fink, who is the former CEO of BlackRock. He's actually written a letter to the CEOs for 2021. And he's also highlighting too that basically the pandemic has caused us to really rethink and to actually take a look at this existential crisis, one from the virus side, but he's also saying it's actually set the groundwork essentially for us to be able to adapt and address like what's happening in regards to this climate emergency. So we want to go ahead and also move on and share a bit about some of the other interesting articles and items that we wanted to bring forward today. So really, does this climate debate boil all the way down to finance, or what are some of the other factors for everyone to be thinking about and considering? And very recently, the world's energy watchdog, the International Energy Association, basically, who's long seen a laggard on this issue, has now acknowledged that that we need to really limit warming to 1.5 degrees Celsius in order to avoid the worst of the climate crisis. And what they're saying is we must actually cease all new investment, whether it's in the expansion of oil, gas, or the coal supply that's already been committed now. So basically, they're also saying too that the lead scientists of the IPCC, the world's leading scientists, have issued what they're calling a code red for humanity. So what does all of this mean? So what do we take away from this? So the messages from many, many different sources, whether it's the scientists or the Energy Association or even UNICEF, it's like the banks are looking at this and saying, okay, we need to stop enabling a lot of these dirty industries, whether it's fossil fuels, coal, gas. We need to invest in clean, renewable energy. And what does that mean? So adapting new types of sustainable practices, new policies, working with the bank's clients, the large corporates, the medium corporates, even the smaller businesses, and saying, how do we create a financial system that fosters a positive climate action through financial incentives? And whether those incentives are government driven or whether that's something that the bank in turn offers to its client base. So again, getting ready for this webinar, there's some very recent headlines I really wanted to call your attention to. So the banks are responding to climate change, and it's very interesting because I've highlighted one from ING on September 15th, where the headline reads, ING is cutting dirty loans as banks purge the books to meet CO2 goals. So that's, really interesting. There's a lot of action happening. Is that the kind of action that we want to see? So the other aspect here too, also another article from September 15th, is the new coal plants. This is from the largest bank in Africa called First Rand. They're basically saying any new coal power stations are not receiving funding any longer. They've been cut from funding. So that's a huge message, especially when you think about Africa, where the sources of fuel may not be as plentiful as in other areas of the world, such as where we have large reserves of natural gas, for instance, here in the United States. So the bankers are taking action. I also wanted to call everyone's attention to a press release that came out yesterday from Reuters, and this was actually from Mark Carter, who's actually the UN envoy on climate change. He's also the governor for the Bank of England, and he's actually turning the conversation sort of on end. And he's saying, look, the financial groups have already done a lot of work, and he's turning it on end and saying that the governments and the nations need to take action, and there needs to be clear, credible, and ambitious climate action needs to come from the government and the policies that need to be set. So he's saying the financial groups have already done a lot of work, and I'm going to show you in a few more slides, and Matthew will help me with this, to show you what we are seeing as well in our research, that the banks are really to be credited. So Mark may be onto something. So this transformation of global banking from finance to sustainable finance, this has been underway for a while. Again, where's the evidence of this? And what's going to be needed as we look towards these sustainable alternatives, and how this is actually going to benefit all the way down to the local communities. And this is an enormous challenge, and it's difficult because, in my work within the Trade Innovation Lab, we're looking at a lot of data, and we're trying to get into the level of transparency that's going to be needed at the ESG and KPI level. And so we need new tools, we need new technologies to bring about that level of transparency and accountability. So, that's one of the things that we're working on day in and day out. And I've highlighted just a concept too, that it's one thing to recognize, yes, there's a problem, but it's a whole nother thing to marshal the workforce and the energy and the money to be able to go solve it. So the next slide actually again highlights where we think the bankers' new role as these climate stewards are positioned. So, how do we get those resources when you're working inside of a large corporation such as CGI or within a large bank or a financial institution? And part of that is really understanding that the bankers are taking on this new type of climate steward role. They're sitting between the carrot of the financial incentives that are offered by governments and sort of, if you will, the stick of these new climate regulations. So there's the carrot and the stick and the carrots, and the banks are sitting in the middle and deciding who gets financed and who doesn't. And they're also looking to hold the hand of their corporate clients and saying, how do we extend our relationships with these suppliers and these large corporates? And so in this way, the banks are really starting to assume that new role. And they're also deciding, again, which projects gets funded and which ones don't, kind of also highlighting too the news releases that I mentioned earlier. They're looking to divest. And in fact, this is on the heels too. The next slide shows you a recent report from just October 4th on Monday last week. Bloomberg actually put out a fairly comprehensive report, one that's really worth reading, where they're highlighting that the banks are deleveraging and de-risking. And they're doing this, and it's just beyond sort of the coal restrictions. They actually are highlighting that they're looking at other sectors. And I found it kind of compelling that they're saying that according to the European Banking Association, a lot of banks are even taking a look at the mortgage market and saying, how do we deleverage, how do we de-risk? And this again from a view as a climate steward and as a, looking at it from sustainability. Also, we can highlight too that the European lawmakers have done a tremendous amount of work. They've really helped to set the stage of like what's needed and what's coming down the pike with their EU taxonomy. So a lot to be understood there and also a lot to prepare for. The next slide actually on the same day, also on October 4th, I'm not sure if everybody caught this, that's why I wanted to highlight it, but Moodys Investors Service actually sounded the warning bell. And they said that banks could be suffering some pretty significant losses regarding many of their loans simply because climate change is here. Whether it's, again, those floods, the hurricanes, the wildfires, these like unprecedented times that we live in, we just can't be sitting still. So these loans potentially could be at greater risk than first imagined. They're also talking too about how to decentral, how some of these different loan qualities are also degrading. So the banks have a big job to do as far as, again, looking back at their portfolio and understanding like where these new levels of risk may be. And also they've highlighted too, like there's going to be action that's going to be needed in regards to the COP, sorry, we've got some people bouncing in on the lobby, the COP26 initiatives as well, and the climate change demands that that's going to bring about. So we know that there's also quite a bit of work that's going to need to be done. So a lot of transformation is happening across the board. This next slide, I'm going to pass it over to Matthew, and he's going to give you an understanding of just how these non-governmental organizations, these NGOs, are sitting within the field of the 4 different types of banks that we have listed. So over to you, Matthew.
Yeah, so I mean, when we look at what the bankers can do, the main thing that they can do is to partner with the various other entities that are working within the economy, right? So UN SDG number 17, which is UN Sustainable Goal, is basically partnership for the cause. So what can banks do? Well, banks hold the key to the economy, which is the money and the flow of money and how that money gets implemented. So if you look at the central banks, they control sort of they're in a leadership position, and they control basically how the banks operate. So the banks are looking for some guidance from them, and we've seen some already with regards to the EU taxonomy, with regards to the Bank of England coming out and looking at climate from a stress testing perspective to prevent fat tails, because their responsibility is for basically financial stability and markets that are actually functional, right? From a capital markets investment bank perspective, I mean, these guys are the guys who will create the market, right? So they're going to create the products, and they're going to create how the products are traded, right? And this is actually the fundamental, most important part of this whole banker's role. And they'll do so by, forcing clients to get responsible for the climate with regards to what they're doing and how they're actually affecting or impacting change. And that sort of the money that they want for the various investments they have to make for the business that they have to run will be contingent upon their performance environmentally or ESG wise. So we're seeing this whole concept of a greenium, which is issuing, say, a bond. Attached to that bond is some KPIs, key performance indicators in certain ESG areas. And in return, the client can raise money at a cheaper rate. The other area we're looking, that's involved is on the retail side. And this is responding to clients and consumers changing preferences and preferences towards environmentalism and preferences towards ESG-focused companies, right? And addressing those preferences on a retail basis, right? And the retail banks have a special role because they're involved at the local level in communities, so they can affect change at that level. Whereas most other investment banks are working at a much higher level, at the corporate level. The other key role in here is the development banks, so the agencies. And the agencies play a role in creating projects that can be funded, right? And creating public-private partnerships. So this is partnerships between government and industry in order to work towards a cause, right? Perhaps the revitalization of a brownfield project, or perhaps the introduction of new green power to the power grid, right? So some of the investment banks, we've heard some of the products that they're coming up with are sustainably linked loans, sustainable bonds, green bonds. So you've probably heard some of this terminology, and you're probably wondering maybe what's the difference, what's it about. So for example, investment banks and capital markets are the innovators, but they do need to establish standards. Why there needs to be standards? There needs to be standards because they're used to comparing things. Things have to be fungible within the market. I have to know that if I'm getting a green bond from this company and a green bond from this company, I have to know which one, how to evaluate them, where do I price them, right? And so capital markets is working with NGOs, non-governmental organizations like the Principles for Responsible Investment, PRI, in order to establish standards by which they can originate these products. So some of these standards are, we've seen the sustainably linked bond standards. So a sustainably linked bond has special KPIs built into it, has a second party opinion. So they have advisors that come in and they look at the issue and make sure that the KPIs are reasonable. They have targets for those KPIs, and they have auditing. And all that goes into securing that greenium or that green premium on the issuance, so that they can issue maybe 25 beeps below what they would normally issue at, right? And then with regards to green bonds, there's special green bond principles where, the money, there's a special use of proceeds clause, as well as second party opinion, as well as in order to ensure that the proceeds are used for a green reason and that the project is actually legitimate. So all these things are coming together. We're seeing, the standards for, sustainable accounting, and we're seeing, the Euro taxonomy. All these things play a role. At the beginning, like when the market was still beginning, like about, say, 10 years ago, you could issue a sustainably linked bond for with one KPI and still get a greenium. Now the standard is much higher. You have to have 3 KPIs, right? So it's an evolving market, and all these groups have to play a role in order to create this market. I'll just move ahead one slide, Nancy. So if you look at slide 12, you see that slim sliver of $3.4 trillion. Right now, the rest is all just financed or debt that's out there, right? All that debt is considered right now, financed debt, or debt that's being financed. But eventually it'll be sustainable finance debt, we hope. So the idea is to transform all of that gray into green, right? And make it into sustainable finance, which should eventually become finance. So we're moving from just finance to sustainable finance, and then sustainable finance should just become finance, meaning that everything we issue should be just sustainably issued through sustainable processes, through sustainable procedures, and the market for sustainability should just be the market itself, right? But right now we're looking at that transformation. So if you see on the other slide, the amount of issuance going on, this year has been quite a banner year for ESG related issuance and sustainable bonds. It's gradually moving up, which is a good sign, but we still have, as you can see in the other graph, a long, long way to go. If you could just move ahead one more slide. So there's a lot of sustainably linked M&A going on now, and there's a lot of sustainably linked loans, right? There's many products out there that are being innovated by capital markets, because that's what we do, and that's what these guys do, in order to accommodate a transformation into a much more green economy and address this global climate emergency that we have.
So with that, as we look to wrap up, I wanted to also say too that, sort of summarizing, that we can take a look at this, whether it's in any one of those four quadrants, that all the bankers have a public duty, and also to ask too what you can do to help. So we're all implicated in the climate change crisis. We're all implicated as consumers, as pension fund holders, and as citizens. You know, one of the first places that we suggest that you start is basically if at your bank or at your corporation, take a look at just developing green products. So shift your existing product line and move it towards sustainable product line or a green product line. We also wanted to highlight too that one of the things that we're looking at is like a global community is that we basically need these types of standards to be in place to help us to have a common language where we can talk and we can actually look at a type of, whether it's a, you want to call it green scoring or risk assessment, that we're all talking apples to apples. So the market still continues to evolve in that direction, and is going to be important whether it's at the consumer level or at the banking or corporate level. So again, an ending transformation is happening. We're moving from recognition to real solutions. And I leave you with a thought as we go into the Q&A, and this again is from Mark Carney, the governor of the Bank of England and the United Nations Climate Envoy. And he's actually, it was really interesting to me, this was from just yesterday, and he actually is quoted as saying the next few weeks in this decisive decade will help determine whether we avoid climate catastrophe. So he's basically saying the time is now, this is the call to action. And this is where he's already saying he's giving credit to the financial sector. They're stepping up, as Matthew's chart showed you. This has been a work in progress for many, many years, if not the last decade or even 2 decades. But now he's saying it's the time for the major economies, the G20, to step up. So with that, we're going to go ahead and move. We've got about 10 minutes left. So opening it up for questions. Hopefully we'll have some good answers for you, comments, feedback. Anyone like to come off of mute and ask Matthew or I any questions? Any questions? Going once? Going twice? If not, I'll ask Matthew a question. So Matthew, what do you see in regards to the markets? Like, what have we seen again in the market so far, and what are you looking forward to seeing in the markets in the next couple of years?
Yeah, so I mean, capital markets and capital markets participants have really stepped up. They've, created these sustainably linked bonds. They've created these green bonds. They've created sustainably linked loans. They've worked with the PRI to create standards for these products. So the main thing is that, like, once you create a market, you have to price, the products within that market. And if we look at the bond market, which is kind of an area I know, everything's priced off the benchmark curve, right? But you have these new sort of esoteric bonds that are, sustainably linked or green bonds, and they're slightly different. So they don't price exactly traditionally, right? So we need to have better ways of pricing those bonds and making them fungible. For example, say I'm looking at a bond that was issued, it's a 20-year bond. It was issued 10 years ago. There's only one KPI versus a bond, issued today. It has 3 KPIs. So how do I, establish equivalency between the pricing of these bonds, right? It's these little market sort of nuances that need to be addressed, and I think will be addressed by the market and by government and by regulators, right? In order to make the market more functional. Because right now, I think it's slightly more functional, but 10 years ago, it's kind of Wild Westy, where you could, issue anything and sort of look credible. And this is the whole, kind of goes back to the main part of this whole conversation, which is the whole greenwashing. We want to make sure that we have, a way of issuing and originating debt that is very credible, that everybody understands, and that's functional, and everyone can agree upon, the value of a particular security or instrument. And I think we're moving in that direction. I think banks really, this year has been really a banner year for issuance in general. Activity's just been crazy. But I think especially towards ESG related issues, environmental and climate, especially being number one on everyone's list.
And what do you think about the bank's divestiture out of these types of, if you will, polluting industries? Do you think that's a step in the right direction?
Yeah, so it's a big topic. I mean, I don't think a lot of banks are divesting, but I think a lot of asset managers are divesting, and that goes back to a lot of these NGOs that are forming up and alliances and associations between a lot of asset managers to sort of take a statement and really force some companies in very, you know, harder or dirtier industries to step up and really be more responsible. And I think we've seen a lot of shareholder activism on this side. I think there's a divide in the industry between, you know, should I just divest? Should I short? Should I underweight? Or should I hold my position and engage? And the market's really quite mixed on this. I think most leading companies are like, it's a better opportunity to engage than divest. So with the engagement, you have the opportunity to affect change, right? So get people on the board and push the company in the right direction, right? And again, like I said, the money is contingent upon performance. So a lot of these larger corporations who do rely on the debt market are going to find it hard to raise if they don't start, you know, reaching the KPIs that they have, or actually establishing KPIs and making sure that their performance environmentally is in target with what the expectations of their asset owners are.
So it's a real balancing act in a lot of ways.
For sure, for sure.
So I think we're very close to time. So I'm going to open it up. Any last questions, comments, feedback from anyone in the audience? I've got one question here popping up. Sharmila, feel free to ask your question.
I just wanted to say that was an excellent presentation. Thank you very much. And to Matthew, is there any way you could share any, you know, popular KPIs or anything like that in this space?
It's very, and I shouldn't, because it should be very, so when you're issuing, you know, your KPIs with regards to a corporate or something should be very much in line with what already you have established as your UN SDGs, your sustainable development goals, right? And they should also be, it's very company specific. Like, you know, if you're Coca-Cola, obviously water is a very important thing to you, right? But if you're another company, say you're, you know, an oil sands company, or you're a forestry company, then you might be more focused on recycling, using more renewable sources or reusable sources. There's a lot of, you know, these KPIs have to be very company specific. So I can, you know, I can't, you know, give you a general idea, but I mean, there's a lot of them, like diversity related KPIs with regards to, you know, establishing more recycling or more use of gray water, stuff like that.
Excellent. Thank you very much. That really clarifies. Appreciate it.
We still have another minute if there's any other questions.
Hi, Nancy. I have a question in the box here, the conversational box, but maybe yes. I can explain real quick. Sorry for the baby shark sound in the background. No So in Europe, we have the EU taxonomy as a framework for banks and businesses to be held accountable on negative impacts that they might have, and then take accountability through ESG disclosure. And also it's linked to their revenue because obviously there are taxable, now we have chemical tax, we have carbon taxes. So how do you convince other regions who don't have these consequences through legislation to take on the same focuses and indicators as we have in Europe and other regions that have more stringent legislation around ESG?
Excellent question.
Great question. There's several levers, I think. I think one of the big levers should be, and hopefully we'll see it soon, is this whole corporate responsibility. So a lot of these corporations work in are multi-jurisdictional, right? So if they're applying to, you know, certain policies and regulations in one industry, it'll eventually, or it should be eventually, be very hard to be credible when you're doing things in a certain industry in one jurisdiction and not in others, right? So, I mean, that's one way of looking at it. And the asset managers will probably hold them accountable for that. But I think we're hoping, I mean, one of the main levers, I hope, will be COP26 when we all get together, and governments really, I think governments really need to take a stronger role in COP26 and really realize what they're, what's going on in Scandinavia, and sort of basically migrate that to jurisdictions like Canada, where, Canada often gets lumped in together with some of the more credible countries. And I think we are doing very good, and we are better than some countries. But the fact is we could do a lot more in this area. And so we're kind of getting a bit of a clean mark when we're not doing as much as we probably should. So I think, working together in this whole idea of partnership will hopefully make some of these policies transferable to multiple jurisdictions, and also we'll get some universality. I think if all governments get together and we have some kind of universal standards, which is what everybody ultimately wants, especially capital markets, that'll be a really great gain. Nicole, again.
Nicole, did that answer your question, or did you have another question or comment?
Yeah, another comment regarding this is that, this is a lot about, game theory, and you can look at it as like the tragedy of the commons, where you have areas where it's like, okay, if we all do this, then we will all be better off. But then you have other people in other regions capitalizing on not participating. And so what we're seeing now in our region of Scandinavia is that there's this concept of NIMBY, not in my backyard, is coming to play, where you have businesses that have, net zero within their scope 1 and 2, but they're procuring other things on their scope 3 and 4 emissions to basically sort of mask that situation, procuring in countries that don't have legislation. So how do banks as an entirety start to drive this from a global standpoint so that it doesn't happen where you have these regions that are basically dumped on because they don't have the legislation?
Well, it comes down to regulation. So there'll be like, it's stick and carrot. I think we're at, the carrot part, the stick should come soon. I think they won't be allowed to, carry as much debt from certain industries or certain bad performing like sovereigns, eventually, perhaps. But I think it'll become logical at a certain point, because from a financial stability point of view, transition risk is extremely high, right? There's an extremely high price to pay for that transition risk. And if you're carrying a lot of that risk on your books, the regulators aren't going to like that, because that's fat tail risk. And we're all trying to avoid fat tails, right? We don't want another systemic collapse of the economy, right? So I think, regulators play a point from that perspective. And we're seeing that from the increased climate-related stress testing that banks are going to have to adhere to, especially in England, and hopefully that's transferable to North America at a certain point.
Excellent
Thanks,
answer.
Matthew and Nancy.
You're
Nice
very
answer.
welcome. And thanks for everybody for sticking with us a couple minutes over time. So we're welcome to stay if anybody has any other questions or feedback. Also, I want to call your attention to that on the contact page, on the intro page of this webinar, is our contact information from Matthew and I. So feel free to email us, call us. I'm happy to set up a meeting and continue the conversation and the dialogue as well.
I think, when we look at this whole thing, to create a really healthy market, there will be, it's like Adam Smith's invisible hand theory, where, people get together and the market kind of starts on its very own. But at a certain point, a bit of paternalism is required in order to make things function in the right direction, right? And I think we're on that road, but more evolution and more development along those lines needs to take place. We're getting there. I think, we came to this spot a little later than we should have, because, all this conversation really started in around 2008, 2010. But the world was a little distracted by the most recent financial collapse, and certain companies, in certain countries took notice, but it didn't progress as much as it should have. And now here we are. and it's more imminent. So hopefully, necessity is the mother of invention, right? And we get some more innovation on the both sides of the markets. The markets are very innovative on their own, but on the side of government too. So.
Excellent. That was a great way to wrap it up, Matthew. So thank you for that. And thanks again to everybody for spending time with us today. And we will be also posting this webinar out on YouTube. So if you'd like to pass it along or forward it to others, feel free to do that as well. I think we're actually posting it either later today or tomorrow. So thanks again, everyone. Thanks for your time.
Thank you.
Have a great rest of Sibos. Cheers.
Thank you.